I'm always looking for problems and making sure you're mentally prepared that something bad could happen. And more important, or equally important, is you need to have an exit strategy for when it rolls over. And so we get in and we get out of the market because you never know when one of the corrections are going to turn into a big sell-off. It's not so much a long-term investment. This is like an active trade. We're looking for it to run up to about 5,100. And again, what it's done is it's pulled back into a support zone. It's just that support. It's oversold and the underlying long-term trend remains up. Silver's doing much of the same thing. Potential little bit of an inverse head and shoulders. It's trying to build a potential rounding formation here for it to break and pop to the upside. It's nice to see actually silver holding up the way that it is. The metals are holding up better. They're not making lower lows at this point. They're not breaking the lows from about a week ago.
Trump and Besant said, we're going to audit Fort Knox. What happened? They had a big report on it, and I think they projected gold at 5,000. Even Jamie Dimon said gold could go to 10,000, right? Peter was of the view that, next year, a year from now, gold would be much higher. I agree with him. 6,000, 8,000, 10,000, all possible.
Markets are at a critical inflection point, one defined by fading optimism, rising volatility beneath the surface, and the early stages of what could be a significant rotation into precious metals. Gold has pulled back from its highs, testing key support zones, while silver holds its ground with remarkable resilience. This behavior isn't weakness, it's consolidation within a broader bullish structure. Both metals appear to be setting up for another surge as investor sentiment turns cautious and equity markets begin to show fatigue. As capital exits overvalued risk assets, the next wave of liquidity could seek safety and upside in gold, silver, and the miners. Chris Vermeulen, chief market strategist at the Technical Traders, and Lawrence Lepard, renowned sound money advocate, both highlight how the psychology of fear and greed continues to drive market extremes. Their analysis points to gold's recent pullback as an emotional reset, not a reversal. Silver's technical structure and minor capitulation suggest that a key low is near, one that could spark the next major leg higher in metals. Gold and silver are quietly preparing for their next move. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Based on the momentum of it and the pullback, usually when you have the first pullback to a key moving average, like if I just go back to the daily chart, when you have a very strong run and rally, one that just shoots up and then you have an emotional kind of blow off phase, when it first drops back to a key moving average like the 50-day, generally it wants to have a bounce and it's going to want to go higher. This is just, even though it has pulled back and reversed to the downside temporarily, overall this is just the first pullback within, I think, this major trend. So it's not so much a long-term investment. This is like an active trade. We're looking for it to run up to about 5,100. And again, what it's done is it's pulled back into a support zone, and sentiment is favorable for it to go higher because people don't want it right now. So it's just that support. It's oversold, and the underlying long-term trend remains up. Silver's doing much of the same thing. It's consolidating, a little more volatile. It is trying to carve out bottom as well. We've got this potential little bit of an inverse head and shoulders. It's trying to build a potential rounding formation here for it to break and pop to the upside. It's nice to see actually silver holding up the way that it is. Sometimes you see it really have some big red bars to the downside. But again, I think they're going to move more or less in sync together. I think the metals are holding up better. They're not making lower lows at this point. They're not breaking the lows from about a week ago. And that's, I think, because they're not connected to the stock market. The stock market is pulling back. Gold miners are stuck in the stock market. And as you and I have talked about, I look at the markets like the ocean tide. When the tide goes down, all boats go down. So if the stock market tide is going down right now, and you got a gold miner that's stuck in that tide, it's naturally going to have more pull to the downside. Whereas gold and silver are a commodity, they're not even connected to the stock market. And so they're holding up better because they don't have that falling tide with the mass psychology of everyone kind of dumping stocks and selling. So I think gold miners are telling us what the sentiment is. People are panicking, they're selling and moving out. And I think it's telling us, and gold and silver are holding up. So I think it's an emotional pivot low. And I think we're going to see the market carve a bottom out if it's not already in for gold and silver here. Yes, I'm bearish. I think a lot of bad things could happen, but I always explain, like, we're long the markets here, even though I do think, that things are coming. So there's a huge difference. I mean, this is also part of the problem of, I share analysis and things publicly. but the investing and the actual trades and stuff is, is for investors who I work with. So I share the analysis on where, are we long, are we short, what do we own in the overall trends, but I can't give the exact details of every position we're in. So people kind of have to piece that together at some point, right? So it's I'm always looking for problems and making sure you're mentally prepared that something bad could happen. And more important, or equally important, is you need to have an exit strategy for when it rolls over. And so we get in and we get out of the market, because you never know when one of the corrections are going to turn into a big sell-off. I mean, if you go back and you look at the big sell-off earlier this year in the stock market, this is the QQQ. Our strategy told us to get out, then we go into this massive sell-off. And then eventually, we got to avoid all this and we got to buy back into the markets at a lower price and then ride it higher. And, one of the comments was something like, this guy doesn't know jack shit. And he says, he said not to buy after Liberation Day. Well, the reality is we did buy after Liberation Day, but we waited until it went from a bounce to a trend. And so I don't just buy after a huge sell-off, because that big sell-off might not be the bottom. It might continue to sell off. And of course, if it did, then whoever bought trying to pick a bottom is going to get absolutely slaughtered, and they're going to be underwater for years. So, it comes down to just understanding the strategy that I have. I'm all about protecting capital. I'm not swinging for the fences trying to make money on every single bounce and drop. I'm trying to identify these waves. When a swell or a wave comes to an end, I want to get out. I want to go somewhere else. When a new wave starts, I want to get in and I want to ride it. It's much slower. 5 to 12 trades a year. I think a lot of people are very active traders and they see short-term signals, and I avoid those because it gets you into a lot of noise and a lot of volatility. I have green as the panic selling indicator, because when we're in an uptrend, you want to buy dips, or you want to know where there's a pivot low. So when the market sells off and our panic indicator, our green one, spikes up, usually it's that day or the day after. So it depends on the level, right? So for example, when it breaks above 3, typically this day or tomorrow can be bought. Usually the market will have a bounce for 1 to 3 days afterwards. If the panic indicator actually closes at 7 or higher, that is a level where, if you go back on the charts a long time, it will usually be a standout low, meaning usually there's so much fear on the close of that day, the fear actually carries over for 1 or 2 more days. So the market can keep falling for 1 or 2 more days because everybody's just running to sell. And it usually takes 2 to 3 days for the world to kind of catch up, right? There's the day traders and the active traders like us who can take action the day something happens. And then you've kind of got a bit more of the working class who come home after work and they see it on the news and like, oh crap. And then they put their order in, they get out the next day. And then there's also people who are a little more lagged and they're like, oh, it's another bad day. Finally, they're going to get out. So depending if it's a very high level of panic, 7 or higher on the scale, then it's usually 2 days later or so, it's a very big buying opportunity in terms of the market being a big standout low on the charts. Yeah, it should be a lot higher. The market should be a lot higher after that. If we look for the stock market here, typically from the beginning of November to the middle of November, the stock market struggles a little bit. So that's right where we are. We actually saw the market push higher going into November, and now it's starting to pull back. If you look on the chart, we had a run up into November, and now it's starting to pull back. So seasonality seems to have its claws into the stock market. If we look at gold, it's kind of the same. Gold kind of holds its ground and struggles. And then of course it still has more pressure into the middle of November. So I still think we're going to see a little bit of profit taking, a little bit of panic selling for the next more so 10 days or so, 7 to 10 days. And then we're going to have a tailwind behind us for the precious metal space and the stock market as we go into that holiday end of year rally. What I find interesting here, and you and I have touched on this, is the stock market was making an all-time high back in 2007. Gold, the yellow line, was pushing up to all-time highs. And then finally, we started to see the stock market struggle a little bit. Gold started to pull back. I kind of believe we're in a similar situation in terms of price action. We've got gold pulling back. There's a little bit of fear in the market, very similar to what we saw just over here in 2007. And what's interesting is if we look on the left chart, I've layered in multiple different assets down below. So we have GDX, which is gold miners. We got silver, platinum, and palladium. And this is what I've been talking about for the last little while, is everyone's been piling into gold. It became a short-term crowded play, which is why we've got this initial little pullback. But you can see that in this chart. When we look at what people have been doing with gold miners, with silver, with platinum and palladium, Money's been moving into this space. So whoever's open to the concept of holding physical metals, they have been piling in. It's been a little bit of a feeding frenzy. Things got a little overbought. When we look at what happens after this, we tend to see the yellow line, gold, shoot dramatically higher, rallies about 30%. The stock market ends up struggling. So I think money pulls out of stocks. Money's always looking for a return. So it's going to move to whatever's got momentum, which is gold. It's also going to be miners. It's going to be silver, platinum, and palladium. So that's kind of where I think we are right now. If we look on the similar chart of where we are, you can see if I was to just kind of move 2007 back, we're in a very similar situation. All of these assets have come to life. It's become the crowded play. We're having the first little pullback and pause. And then I think we're going to see gold in the precious metal space shoot higher fairly dramatically. I think gold's going to go to 51, 5,200. Silver is going to shoot higher. I think that's kind of where we are. We're right in this cusp of just the last month or two where I think gold and the precious metal space have one more big run. And the big question is, does the stock market stall out and the money coming out of equities, does that get pushed into precious metals to create this giant rally? So that's what we're just kind of waiting to see. And gold kind of shows it in a little bit more of a kind of a relaxed way. It's not moving quite as dramatic as the miners, but overall, it's just an unwinding of events. So for example, gold had hit our measured move right over here. We ended up playing this really nice trade to the upside on this breakout. And then after that, it went into this kind of bubble feeding frenzy mode. And everybody who got out with me on this target, because it was a pure technical trade, that was our target, get in, get out. Everyone had FOMO at this point. Everybody's like, why did we get out? I have to get back in. And tons of people got back into gold because they thought they were missing out and it was going to go to the moon. And now here they are underwater. And now I actually like gold here. And everybody's like, why do we want to get into gold? It's reversed, it's selling off. And so these are these important like turning points. When everybody wants it, you don't really want it. And when nobody wants it, especially when it's in a super bull market like gold right now, that's usually marking a low. So I think gold is trying to find a bottom here. I think we're going to see that happen fairly soon because everybody seems to be bailing on their gold miners. As you said, they're moving out, they're selling off, and they're kind of giving up on it. And I think we'll see a bottom potentially this week in the precious metals space. And miners are down the most because they're kind of this very liquid. They're not very liquid in terms of they sell off. They're a small market, and when people sell them, they drop quickly.
Gold and Bitcoin are both thriving as the global monetary system quietly shifts beneath the surface. What's unfolding isn't a coincidence. It's a reflection of waning trust in fiat currencies and central bank policies. As government debt spirals and deficits grow, the constant need for liquidity has forced policymakers into a perpetual cycle of money creation. The result is simple. Sound money assets are reasserting their dominance. Gold continues to prove its resilience as the analog store of value, while Bitcoin, still early in its adoption curve, represents the digital frontier of monetary independence. Together, they form two sides of the same escape valve from systemic debasement. The rise in both reflects a collective understanding that fiat systems will always print their way out of crisis, even at the cost of credibility. Central banks, institutions, and even governments are positioning quietly, preparing for a world where tangible and decentralized money regain center stage. Let's get back to the interview.
Bitcoin and gold are both going up a lot in fiat terms. I mean, we'll talk about it, I'm sure, in a minute when we get to macro. But, the broad theme is that the U.S. government can never stop printing money, and therefore macro currencies fiat currencies are doomed. Okay, so we know that as a backdrop. But within that, gold and Bitcoin compete in the sound money space. Gold is analog sound money. Bitcoin is digital sound money. Gold has a much longer track record, has a lot of great properties that make it better than Bitcoin in some ways. Bitcoin has some properties that make it better than gold in other ways, and the biggest one of which is that it hasn't been fully adopted yet, that we're still in the early adoption phase of Bitcoin, even 16 years in. Right now, Bitcoin is, if you chart, and I have a presentation tomorrow here at the show that I'll be putting on that everyone can watch. You can buy it and see it online at 2:30 or something, where I actually chart Bitcoin in gold terms. And they zigzag back and forth. There are times when gold takes the lead, there are times when Bitcoin takes the lead. However, on an overall basis, the price of Bitcoin in gold terms is going up and to the right. Now, right now, it's against the lower trend line. So if you're trying to decide today, if you have $1 to invest or $1,000 to invest today, and you're looking at, I want to make a sound money bet today, Bitcoin's actually cheaper today than gold because gold's just gone up quite a bit and Bitcoin's actually been relatively flat for a while. So, but that situation could and probably will reverse. But personally, I've actually used that opportunity to sell some of my gold stocks. I have gold stocks that are up 200, 400%, and they maybe are becoming more fairly valued. I think they're deeply undervalued. And so I've sold a few of those, and I've used them to actually buy Bitcoin today at 100 and something, which a lot of people would say, well, that's awfully expensive. But as you'll see in my presentation tomorrow, there's a model that shows kind of the price of Bitcoin over time and as its adoption curve continues, and it shows that we're going to much, much higher prices, and that's a discussion unto itself called the power law. I don't know if you want to go there or not. Central banks have been aggressively on the bid for a long time, so that's kind of the first big move. But I think the second big move, I think this more recent move, it could be a lot of things. Andy Schectman and others suggest that maybe the U.S. Treasury is on the bid for gold. Let's talk about that for a minute. So when they came in, Trump and Bessent said, we're going to audit Fort Knox. What happened?
It's been awfully quiet on that front.
It's been awfully quiet on that front. Here's my guess. They got read in. That some of the gold's there, but not all the gold's there. So maybe some of the bid in gold is the U.S. Treasury on the side buying gold to refill Fort Knox. An old gold hand told me that Johnson raided it in the 60s in order to support the London gold pool in the 60s. So I don't think they have all the gold. They say they have gold in Fort Knox, and maybe that's part of the bid. But I think at a broader level, there's some other things I think are really big touch points. So JP Morgan recently came out and said that they now have a term for what's going on in gold and Bitcoin, and they're calling it the monetary debasement trade. And they announced this. They had a big report on it, and I think they projected gold at 5,000. Even Jamie Dimon said gold could go to 10,000, right? And then Mohammed El-Arian, who's a huge institutional investment manager, listened to and followed by millions, considered very authoritative.
He's the Dean of Cambridge.
Yeah, right, Dean of Cambridge now. But he ran Allianz, he ran CalPERS, he was at Harvard Management. I mean, he's a heavy. And he came out and he said he believes in, quote unquote, the monetary debasement trade. And so, and you know, you've got guys like Jamie Dimon, who was anti-gold for most of his career, saying, well, I can understand how in this circumstance, you know, gold at 5,000 or 10,000 could occur. And so what you're kind of seeing is just a growing, you know, it's the common knowledge game. I mean, you and I knew this years ago, right?
Yeah.
Gold people who've been buying gold for a long time have known it for some time. It was creeping into the mainstream. It's now almost really going mainstream. I mean, it's kind of like, okay, you know, we've got big names. I mean, Ray Dalio saying you got to have 15% in this stuff. You know, guys like Larry Fink, who runs BlackRock, who was anti-Bitcoin, you know, turning around and saying, no, we're going to open the first Bitcoin ETF. It's going to be the biggest growing ETF in the smallest amount of time possible. And I believe Bitcoin is digital gold. Fink has said that. I mean, this is a fiat guy, right? So, you know, Scott Bessent the other day, he took a shot at Congress. I loved it. He tweeted out, he said something like, you know, congressional Democrats should take note. The Bitcoin network is still working and always keeps on working. It, you know, it can't be closed like our government. You know, note to Democrats, right? I mean, I just thought, okay, that's positive. Stephen Moran, the most recent Fed chairman or Fed appointee from Trump, just got a seat on the Fed board. I mean, he was on Twitter a couple of years ago when problems would come up in the monetary system, and he was tweeting, Bitcoin fixes this, right? Trump is pro-Bitcoin. So, you know, you've kind of got this realization. I mean, Trump told Judy Shelton, who then told Andy Schectman, that he could see doing a gold-backed treasury bond in July.
50-year gold-backed bond.
A 50-year gold-backed bond in July of 2026 on the 250th anniversary of the country. I mean, these are all signposts, right? These are all signals. You know, Scott Bessent, who's the Treasury Secretary, when he became Treasury Secretary, he came in, he was interviewed, and he said, you know, he identified, and he said it kind of subtly, but he said, I believe we have trouble with our monetary system, and that some kind of a restructuring or reset might be necessary, that something that would look like Bretton Woods, which is the last time we reset the system in 44, and if that occurs, I want to be at the table. Well, that's a big clue. So now, I'm sure your listeners can say, well, okay, Larry, tell us what's going to happen. I don't know what's going to happen, okay? But what I do know is that governments and other things, they give you clues before things happen. And could we do a gold reset? Yeah, we could. Could we do a gold-backed bond? Yeah, we could. Could Bitcoin, could the U.S. government start buying Bitcoin and adding to the strategic Bitcoin reserve? We could. I mean, there's a senator pushing for it, Senator Loomis. Will it happen? I don't know. But I do know that as the existing system continues to creak and break, as we're seeing right now, the SOFR blowout and the standing repo blowout, and the balance sheet's about to expand. I mean, Lori Logan, Fed, just said that. Jerome Powell said that. He said, well, because reserves will be shrinking as a percentage of total GDP, there's no doubt we will have to start to add to reserves. He just announced he's going to QE again. That's what he said. In code, he said it. He didn't say we're QEing, but that's what it is. Peter was of the view that, next year, a year from now, gold would be much higher. I agree with him. 6,000, 8,000, 10,000, all possible. And Bitcoin would be much lower.
Yeah.
Because he's looking at the chart right now. The gold guys are pretty happy because this year calendar year this year gold has beat Bitcoin. Okay, not 12 months. 12 months are about the same, but calendar 2025 gold's ahead of Bitcoin. So when liquidity is tight, they tend to get hit harder than gold. I mean, the other thing you'll see on my Bitcoin gold chart tomorrow is that gold is much more stable over time. And gold holders are not fickle. You don't buy gold and sell it the next day, whereas crypto people, they're trading the shit all the time, right? And so when liquidity there's a certain piece of the crypto bid and the Bitcoin bid that's liquidity driven. And so in my view, the fact that Bitcoin is actually soft right now makes me wonder if maybe some of the Mag 7 and the tech stocks are going to get soft. It also makes me wonder if just overall the stock market's going to get soft. It also we haven't gone here yet on macro, but also kind of dovetails with some of the things we just saw over the weekend where, the SOFR rate has blown out and the standing repo facility got accessed very quickly and aggressively. And so, I've always said we're going to have another big print. The Fed was shrinking its balance sheet until this last Fed meeting when they pivoted and said, well, we're stopping the shrinkage as of December 1. And then they also even went so far as to say, and we will probably have to start growing again. Well, there's no way that's not QE, and QE is money printing. And frankly, I think all of that was smelled by gold earlier this year. I mean, gold was up and to the right most of the year, and then in September, it really took off, as we all know. Stock market's at record highs. Gold just hit record highs. Bitcoin was recently very close to a record high, or hit a record high like 3 weeks ago. Silver's at record highs, just broke through 50, right? Employment, maybe a little mushy, but not falling apart. And the Fed's cutting rates? Huh? What's that all about, right?
Yeah.
And I think the reason they're doing it is that they understand that behind the scenes, the debt markets are creaking. They're having distress. Inflation's still 2.9, CPI 3% or higher, and it's really higher than that because it's measured wrong. But he says that to his credit he says, well, there are significant risks to the inflation mandate, but don't worry, we can cover those. I'm not sure how. And there are significant risks to the employment mandate because when they restated the employment numbers and Fed fired the woman who was keeping score, that showed that the employment is kind of soft. And, it really is, as I think we've all been talking, it's a tale of two cities, a tale of two economies. I mean, the upper third of the country in America is doing okay.
Yeah.
I would say great, but I would say okay. Jobs, incomes, food on the table. The bottom 2/3 of America, they're hurting. They're really hurting bad. But I think what we can see, and the reason why I think gold and silver have had such a stupendous run this year, and I believe this will continue, by the way. Some people think, well, now it's over, sell it. No, I think it will continue, is that I think that in May we know that a Trump appointee will be a much more dovish Fed chairman, that the Treasury under Bessent will be much more aggressive, at doing, he's kind of doing shadow QE. I mean, he's selling short-term bills to buy long-term bonds. It's a twist, right, to keep the interest rates down. And, I fully expect that QE, yield curve control, balance sheet growth, all those things are in our future. And all those things imply much higher inflation. I watch the dollar compared to gold. I watch the dollar compared to Bitcoin because those are two currencies, or one's definitely a currency, gold, and Bitcoin's an emerging currency. I think that's the right way to view it. It's not a currency yet, but it's going there, that really cannot be controlled or printed by governments. And so when people vote for either gold, silver, or Bitcoin, they're saying, I just don't trust you guys not to dilute my dollar. Yeah. So to me, that's the important issue.
Gold and Bitcoin are moving together for a reason. Both are quietly signaling a more profound shift in the global monetary order. The world is watching inflation slow on paper, but beneath the surface, the foundation of fiat currencies continues to erode. Each rate cut, each new form of quantitative easing, each fiscal rescue plan only reinforces the same truth. The system requires perpetual expansion to survive, and that expansion destroys purchasing power. Gold and Bitcoin rise not because of hype, but because of mathematics. Too much debt and too many promises that can never be kept. Investors and institutions are waking up to this long-term structural story, the one where physical scarcity and digital finality are starting to replace trust in central banks. The shift is happening quietly, but decisively, Every liquidity event, every bailout, every temporary measure accelerates it further. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.